Welcome back to Market on Close. Time now for Overlooked Stocks. George Tsilis, senior markets correspondent here on the Schwab Network, joins us now to take a closer look at EVgo. The EV charging company hit a 52-week high today. So what was the catalyst behind? I mean, it had a sharp jump today, George.
Yeah, in fact, even yesterday, Diane, the stock moved quite aggressively to the upside. So it's had a great couple of days for EVgo, which is essentially a fast-growing company in the direct current charging network platforms. In other words, they set up charging stations for electric vehicles. And there's been several catalysts, in fact, over the past couple of days. And I'll go over another catalyst that I saw based on last quarter's earnings. But, yesterday, the company announced they received basically a $1.05 billion grant, or a loan, if you will, from the Department of Energy Loan Programs Office to build out 7,500 charging stations across the nations between 2025 and 2030. So that in of itself is actually quite large in terms of the loan program. And these loan programs from the DOE, by the way, are very accommodative in terms of the terms, the favorable positions that the company can actually use that capital. And what that ends up doing is it changes the capital structure of the business because it's less reliant now on equity financing to expand its charging network. If you look at the debt load of EVgo going back to last quarter, $82 million in debt on $2 billion in equity. So the company wasn't really in debt to begin with as much as one might seem, or even compared to some of its competitors. But this loan program is actually quite large relative to the equity base. And I think the market really picked up on the fact that this is a great deal for the business to expand its charging network. Now, there's other catalysts as well. Now, the other thing about this particular company relative to some of its competitors, and some of the other competitors you may see come across the ticker tape is like Blink Charging and ChargePort. Essentially, EVgo's technology is more adapted to fast charging. And in fact, it's compatible with 11 different original equipment manufacturing vehicle companies, including Tesla, which is also one of the major competitors of EVgo. But with that said, I think the technology of this company relative to those peers stands out, and the financials do as well. If you look at the three companies that I just mentioned, ChargePoint, Blink, and EVgo over the past 3 years, you can actually see a significant outperformance of EVgo relative to those two peers. And in the last 6 months, this stock has actually been higher by close to 200%, really outpacing its peers. And one of the things I did notice going back to last quarter, the company seems to have reached a free cash flow position that's positive. And so I talk about this with Oliver all the time, that once a company reaches that threshold of positive free cash flow, that does, or it can start to move the needle higher for the company to become more break-even, profitable in terms of its break-even rate on an adjusted basis. And so I think that's quite compelling. The technology, the grant, and JP Morgan also, basically placed the stock on a catalyst watch list with a $7 price target because of that favorable loan deal from the DOE's loan program office.
So that is and thank you for the correction on the pronunciation, EVgo. So with that, it being on the watch list, it has a kind of favorable outlook. What are the challenges for it? I do think, to your point, the fact that it has the fast charging, that's been one of the concerns about the EV space and wider EV adoption. Yes. But what are the challenges to its expansion?
Well, it's a good question. Well, first off, if you just look at the estimated sales growth, this year they're expected to sell about $250 million worth of installations and services. They're expected to grow by 2026 to about $450 million. These are the estimates. But if you go into 2026, the company's not expected to be profitable on an adjusted basis. So you've got a long ways to go. At the very least, maybe until 2027, until the company's actually profitable. I think that's going to weigh on the stock, maybe in the medium to longer term meaning the next year or two, because of the profitability profile. Now, some of the other risks would include competition from well-capitalized companies like Tesla. You have to think about those risks, as well as essentially perhaps risks to the entire EV market. When it comes down to demand and adoption going forward, potentially a recession in 2025. The other thing about this company, though, that I will mention is they seem to be very well versed in terms of the number of subscribers. So they actually have about 1 million subscribing users on a monthly basis. That's been growing quite significantly, particularly the rideshare component of their business, which is about 25%. So companies like Uber and the drivers who use or sell their services to riders, they utilize their services about 1/4 of their total services. So I think it's quite compelling as a cohort of users that can certainly grow, because we know that rideshare is not going anywhere anytime soon, and in fact, it's probably going to continue to grow as things like car affordability become more challenging for the broader economy.
Yeah, you make a good point. And also, are you seeing any data that shows the demand? So, because the EV space has been challenged this year, right? We've seen some growth in
Yes.
adoption of EVs and sales, but it's been like single percentage growth when you look at this year so far compared to what 2023 was, where it was more gangbusters in terms of adoption. What are you noticing in terms of the patterns there, George, for these EVgo, which would obviously they would be a recipient of growth and adoption of EVs?
Well,
Or EVgo,
yeah, I mean,
sorry.
good question. I think in the broader context, you have to look at the development of this market. In other words, the EV charging market. There'll eventually be between 2 and 3 major suppliers of EV charging networks and installations in our country. I think Tesla obviously is one of them. I think EVgo is probably going to be another one. And there's going to be a lot of competitors that just don't survive. So I think what it comes down to right now is the companies that are improving their scale. This is what everyone is looking for with Tesla coming up. They're not necessarily looking for the most revolutionary technologies. I know some are, but most of the analysts are looking for expansion and EBITDA margins going forward. How much more profitable are they becoming? So the companies that are getting more closer profitability than others, and I'm going to use Blink and ChargePoint as a couple of competitors of EVgo, which are not as close to profitability, they're going to face some growing challenges versus those that are better capitalized, and I think EVgo is one of them. Not to mention, of course, you have to consider some of the analysts like JP Morgan. They're not going to rate a stock, as a catalyst watch unless there's something compelling there. I'm not saying it's a buy. What I am saying is that the capitalization of the business is improving, and that's a good catalyst.
All right, we'll leave it there. George Tsilis,